So, I want us to look at a summary of what finance is all about. And you will relate because I know I've been out for some time, so probably the summary might have skipped one or two times. So when you look at financial accounting, just as a recap, we say that accounting is a process. Can you remember? It's a process, and the process has how many levels? We have the first one is financial transaction. The other one is financial documents. We have the final one, which is the next one, which is journals. We have ledgers, trial balance. This one we always assume it is like simply for the purposes of conformity. And finally, we have financial statements. Financial statements, where we stated that the financial statements are 1, 2, 3, 4, and 5. The first one is statement of profit or loss. The next one was statement of financial position. Then we have statement of cash flow, where we have statement of equity, and finally notes of accounts. So we handle what is financial transactions using the definition that is there. Tulisema, you only record transactions that have the economic value in it. If it does not have any economic value, then you do not record it. And the best example we gave is that this word finance basically means anything to do with money. Okay? See, finance is better. Or either finance, accounting, economics. The main thing that is happening in all this is that money is involved. Then this word transaction, we say the word transaction is in two. There is a movement. And every time we see action, it means more than one person is involved, or rather more than one thing is involved. So this is if we was to define financial transaction, it means there is a movement between two people and money is involved. So one of the questions we say is that a promise is not a financial transaction. Why? Because there is no movement of maybe goods or services from one person to the other. So a promise is not a debt. But if we move to maybe you sold goods to someone, we can see the goods coming from your hand to the other party. Then money coming from the other party to your hand. Then this is a financial transaction. If that happens, then you are supposed to record it in the books of accounts. Then we say financial documents is where it is the evidence that a transaction actually occurred. A financial document is an evidence that a transaction occurred. If you go to a supermarket and you buy some goods, what is the evidence that you bought goods from a supermarket? It's a receipt. Okay? So the receipt is a financial document. And you say accountants only record goods that have financial evidence. So if there is no document to confirm that, then we don't have it. And some of the documents we analyze here we have invoices. We talked about invoices. We talked about debit notes. We talked about credit notes. We talked about what else? Quotations. Quotations, we gave a reason why I'm giving here quotation is because in examination they always tell you, can you define the term quotation? Of course, we know now in a setup of accounting, quotation is not an accounting document, but it is used as an evidence that there is something that you had intention of doing. Okay? So we have quotations. Next, we have what? We have local purchase order, or rather what we call service purchase order. And then we had another one here called what was the last one? I think we also have brochures. This brochure also, we gave it a definition because sometimes the examiner will want you to define what is a brochure. Okay? Those are the things that we talked about in full. So we went through all this, and I think we defined this, we also defined this. So now we are supposed to define what are ledgers. Journals, we said journals is simply a diary. Just the definition of a diary, for us who have used diaries, you record the day-to-day transaction of your life in a diary. So the same way, if you've worked in a shop, sisi wote tunafanya kazi mahali kwa duka. Ama namna gani? So unajipata kufanya kazi kwa duka mahali. So when you're working in this shop, unajipata that sometimes ukiachwa kwa duka unaambiwa that you ensure that everything you sell, write it in this book. Everything you purchase, andika hapa. Mtu umeuzia deni, andika hapa. So what you are doing is that you are journalizing from the word journalist. So you are simply writing things as they occur. But you are using what? The document. Sawa. Then at the end of the day, or rather at the end of the period, let's just say the day, you are supposed to summarize what you wrote. And I think I gave examples of how we summarize, okay? After summarizing, then you further summarize into a trial balance. You're going to look at trial balance in a later date. But let's first, after summarizing, this is the main reason. And you say from the definition we have of financial accounting, the main reason why we prepare all this so that the user can make a decision. And we separated all this into three ways. We talked about recording. The second one is summarizing. So here and this one, we are summarizing. And finally, this one is we are analyzing for the purpose of decision making. So financial accounting is divided into three aspects. And that's why if you go to the table of an accountant, he is either recording, or he is summarizing, or he is analyzing. He is ever busy. He has something to do. Sawa. So that is how financial accounting operates. So today I want us to look at ledgers. We understand what is ledgers. Then we move ahead to financial statement. I use the easiest term for the purposes of examination. The easiest terms possible for you to understand. If you're in the other side, I could have given you an example of ledgers, but I'll ensure that next time I'll tell you very more. So let's write ledgers. This is a summary. This is a summary. This is a summary. This is a summary of the journals. This is a summary of the journals. Stating clearly that the transactions occurred. Stating clearly that the transactions occurred. The summary may be done. The summary may be done. The summary may be done. The summary may be done on a daily basis. The summary may be done on a daily basis. The summary may be done on a daily basis. According to the classification, of these ledgers. They are also known as accounts. They are also known as accounts. So let me summarize it. Let me just wrap this board. Instead of writing a whole sentence to explain this part, I just want us to look at I just want us to draw, what do we call it? I want us to draw a table. Say this is a ledger, right? Sometimes you can call it. It is also known as accounts. Account tu ni kitabu, sawa sawa. So accounts, we have two types of accounts. Do not confuse this with what I said about assets. Kumbuka kitu tulisema about assets, types of assets. We have intangible, tangible assets, we have non-current assets and current assets. So let's not confuse between these ledger accounts and assets that we have. So the first ledger account, we can have ledger into two. We can have personal accounts and impersonal. Under personal accounts, we can have under impersonal accounts we can have real accounts, and here we can have nominal accounts. Real accounts and nominal accounts. So we define what an account is. It is simply a summary of the ledgers. So when we talk about personal account, we can try and explain it. They are either natural or artificial person, e.g. examples include what? We have debtors. See, debtors either linked to. We have capital, and you have what else? We have creditors. These people are individuals. We can also say the balances are taken to the statement of financial position. The balances are taken to the statement of financial position. Then we have real accounts. Real accounts, you can say real accounts. They are all other assets that are not persons. So there are any other asset that is not a person. They include what? Okay, we can say they are balanced. They are the balances are taken. The balances are taken to the statement of financial SFP, statement of financial position. They include cash at hand, cash at bank. We have cash at hand, cash at bank. Okay. The other one we have what? We have inventory. The other one we have motor vehicle, land and buildings. These are not humans. Land and buildings. We have motor vehicle, furniture and fittings. Furniture and fittings. Okay. As we write that, I want us to also to look at nominal accounts. So nominal accounts, just explain it. Okay. For nominal accounts, you can just write here, the pen has refused. So the balances, okay, this one you can say they expire, they are characterized, they expire after 1 year. 1 year. Say the balances, okay, we can try and define it again. So here we say the nominal accounts, they expire after 1 year. They are activity in nature. They are activity in nature. Try to define what is activity. I can say they are the reason, they are activities involving the primary reason why the business was formed. So if the business was formed to sell shoes, to sell shoes, the activities involving the selling of shoes is what we call those transactions that involve the selling of shoes is called what? It's called nominal. They include, you can say they are taken, the closing balances. The closing balances are taken. The closing balances are taken to the closing balances are taken to the statement of profit or loss. Closing balances are taken to the statement of profit or loss. They include sales. So we have sales account, sales account, purchases account, we have return, inwards account, return, outwards account. We have other incomes. We have expenses. Is there something I'm leaving out? Yeah, those are the ones that expire after 1 year. And you can see when you talk about personal and real accounts, I would say the easiest way of looking at it is that personal and real accounts are like nouns. They are things you can see. They are things that you have at the end of the year. But nominal accounts they are like verbs. They come as verbs, because when you say sales, what is sales? Did you do inventory? I took for inventory. So there's that term sales that I'm going to define in the next class. To learn what is sales. When I say purchases, what is purchases? When I say inventory, what is inventory? So we need to understand those terms in the next few minutes. I'm going to look at them. I don't want you to put your heart so much into this, into cramming them. The only thing I want you to know are examples of real accounts and examples of personal accounts. And note that real accounts and personal accounts are transferred to the SFP. And these examples are transfers to the P&L, okay? That is the only thing you should understand now. Because tutarudi na kuzidefine and again, and you do enough questions. First of all, do you have question papers? But there is one piece that you need that's sitting. So, that's sitting. We need to go the whole thing. So those who are doing ATD, you're going to have two kinds of papers. You're going to have for CPA and for ATD. Most of my questions will be for CPA. But when we are doing trivia questions, trivia means that nitakuwa nauliza swali from nowhere in the classroom. Nikauliza swali from nowhere in the classroom, it means that I'll be using ATD classes. So you can have 2 minutes break, kidogo tu, just 2 minutes break. Then I proceed, kidogo tu. Okay. So I want us to look at two things. There are major things that we go through here. We have not handled what is capital. I know we define capital as the owner's claim towards the business. We are still going to have a small subtopic around half a page to explain what is that owner's claim towards the business. Okay? Also, this one, I know we have not explained it, but we are going to look at it thoroughly when we'll be looking at something called control accounts. We're going to look at something called control accounts. So that is another topic by itself. Na inakuja kwa mtihani. Sijui kama ilikuja last sitting. From what I'm seeing, I don't see anything from last sitting in that. Then here we have cash at hand. I'm going to handle this. And you know, cash is both a ledger and a journal. I've not explained it so much. So this one will have another topic explaining what is this. Inventory, we have a topic of inventory, IS 12. Rather, we're going to define what is inventory, or rather what you know as stock. What is stock? We're also going to look at what is land and buildings. Land and buildings and fittings, we are going to do something called property, plant and equipment movement schedule. All these are topics that we're going to handle. And of course here, these are activity based, right? It means the activities will borrow from these two. We ask ourselves, how did we define an asset? Unaweza kumbuka tu bwana sasa hapa kuna tu mtu I don't know where the other people decided today. I have totally another new class that I did not have last time. What is an asset? Leo ndio tutaumia. What is an asset? What is an asset? This is an economic resource controlled by the entity whose future use will lead to cash flow. It means that the main definition of an asset for the purposes of this class is that you need to use that thing so that in future it can give you money. When you use it, the usage is what will bring to the statement of profit or loss. Sawa. This is the usage, this is the activity, but this is what we have. So every time you think about income, you think I am using my asset in the SFP to come up with this. Then at the end of the year, we ask ourselves, after doing all that, what am I left with? You prepare the SFP. That's why to figure for SFP, I'll be using when we talk about statement of no profit and loss, we'll be saying for the year ended. You just see that, and then the other one is it as at. Tutaangalia acha nisiende huko ndani sana. So the topic that I want us to do, I said this one will be recapped after the two topics. After this and this and this and this, I'll come back again to this thing. And now you'll see another new way of doing it. So let's have a new topic. We start by defining. Let's start by inventory. Let's start by inventory. Let's just say inventory. A topic, call it inventory. Hi, to listen. We say that my class is always a class of discussions. Let's ask, what is inventory? Okay, what is stock? Si unasemanga niko na stock. Stock ni nini? Kila mtu anaongea. Sasa kama kila mtu you always use the term stock. What is stock? What is stock? Stock ni nini? Sasa tuanze wapi? Huko nyuma, unajua watu nyuma wanadhani ati rafiki wangu haraka. Yes, mzaya, tunakutaka mzaya. Mzaya, what is stock? Si mtu sema niko na stock. Ukisema uko na stock inamaanisha nini? No answer is wrong. All answers are correct. You only want to bring all the 4 answers of the 5 or whatever to make it into one to one. Now which one is what? What is stock? The name is Mel. No, is it? Is it Mel? Yes. What is stock? Hey. Sasa mnataka kujifanya ati haujisikia kina stock? Hamjuangi ni nini? Ukisema okay, what is an asset? Let us get the name stock from the word asset. What is an asset? Ulisema it is an economic resource controlled by the firm whose future use lead to cash inflow. And tumesema inventory is an asset. Inventory is an asset. So technically from our definition, it should fit into this. Even without going so far, we know my definition should fit into this. Now, because I don't want it to look so hard, let me define it this way. Andika. These are goods. These are goods held. These are goods held with an intention to sell. These are goods held with an intention to sell. These are goods held with an intention to sell. So now something is coming up here. We have goods, we have intention to sell. Let me give you a very good analogy. Two analogies. If let's say, which business are you good in? Sasa tuko hapo. Unajua kila swali inaendanga. So ujiulize wewe the next question. Which business are you good in?
Any business?
Yes, that a business that you know you can do.
I can do sales of goods.
Sale of goods. Which goods?
Mostly the market, like in Zambia.
Lazima upate moja. So that all of us are aligned to this. It's always good to use practical examples.
Mostly these consumable goods, like
I want a name of a good. I want us to use one good.
Bananas, I can say bananas.
Bananas. Now let's use bananas. You buy 3 batches of bananas. They don't have batches, have a bunch or whatever. Let's say 3 baskets of bananas. But you have a function at home. When you buy these 3 baskets of bananas, sasa hiyo ulifika soko, kabla uite mtu apeleke hii 1 basket at home for the function, customers wakakuja wengi, wakanunua baskets zote 3. Question: what is goods then? And I'll answer it for you. When the 2 baskets, you bought them with an intention to sell, right? But the 1 basket, there was no intention to sell. If I was to use accounting concept, I will only account for the 2 baskets as sales because when I was purchasing it, I had the intention to sell. But the 1 basket, I will account for it as other in tutangalia. This is just something else as a by the way. Sawa. So when you're purchasing, you should ask yourself, do I have the intention to sell when I am purchasing that asset? That is the main thing that you should have. Tumeelewana? First of all, it is a good. Goods mean it is tutasemaje? And I don't want to give the complicated definition according to international financial standard, but it is something that you purchased. So after you purchase it, you are holding it, and when you are holding it, you have the intention of selling it. So tunasema saa zile unaipurchase lazima uwe na intention ya kuuza. Sawa. Now we say that at the end of the period, after you purchased, bought nini umeuza umefanya nini, you are supposed to go now to your stores and ask yourself, how many baskets of bananas do I have left? 1, 2, 3, 4, 5, 6, 7. Then you say, now it is the end of the year. How will I value my bananas, because some bananas you bought them at 50 shillings, other 200, zingine 150, zingine zitoka. Then these 10 that you have now in your stores, will you know which one you bought at 50? No. So how will you value them? The intention of this topic is to know how to value your closing stock. Tumepatana? Because you are always in the business of buying and selling, you may not know what you bought at what time. So to say, stock, let's use the word inventory. Inventory is valued. Inventory is valued. Inventory is valued at the lower of. Inventory is valued at the lower of cost. Inventory is valued at the lower of cost or net realizable value. At the lower of cost or net realizable value. We say inventory is valued at the lower of cost or net realizable value. At the lower of cost or net realizable value. At the lower of cost or net realizable value. At the lower of cost or net realizable value. So when you talk about cost, first I explain, net realizable value is simply market value minus cost of sales. Okay. While this one, I'm going first of all to write them. It is then explain. It is actually the cost include cost of purchase, cost of conversion, or rather cost of taking the asset to its present location and position. So let me explain. We'll talk about net realizable value, and I want to explain using a specific bananas that we have. If you bought bananas at let's say 300 shillings a batch, and now someone, let's leave alone the purchase. Now let's say someone wants to buy your banana at 500 shillings. First of all, tunaongea kuhusu the cost. Let me not go at the selling price. Tunaongea kuhusu the cost. How do you value it? It is the lower of cost of net realizable value, and we say the net realizable value is the market value minus cost of sales. So let's say someone wants to buy these bananas at 500 shillings, but pale umeandika free transport. It means you're not going to charge this person transport to take the bananas from your shop to his home. Okay? Umeandika for free transport. The cost you incur to transport this banana from your shop to that person's home, you are supposed to deduct it from the amount. What I say maybe in an easy language. Kama uko na the market value of bananas is 500. Lakini after umetuma mtu wa pikipiki, the cost of doing this sales is 50 shillings. It means then the amount that you'll be left with is 450. The amount you can realize from that transaction is 450. Hence we use the term net realizable value, because we can only realize for 50. Ingawaje that product we are selling it at 500. So we look at 450. Then that is the amount that we say the lower first. And I say that the amount I can recover from this transaction is 450. Then the next thing I will ask myself, what is the cost of purchase? Maybe I purchased it at 300 shillings. Cost of conversion, cost of conversion is simply changing it from raw materials to a finished goods. Maybe when they came, zilikuwa zinakuja iko na matawi, iko na nini, and you have to hire someone to remove all those matawis and everything, they into a sellable state. Okay? Maybe use some 50 shillings here. Then you also need to take it to your shop. When you say the current location and position, labda hizo vitu zilikuja zikaachwa pale kwa market. You cannot sell them there because you have a shop. You have to take mtu wa pikipiki, azichukue, azilete hapa. That cost of again bringing them to your location, let's say ni 70 shillings. So tutasema the cost is 300 plus 50 plus 70, that is how much? 420. So we'll ask ourselves, which one is lower? The lower is for 20. So we are going to consider for 20 as the cost of inventory. Tumepatana? Kama hujashika tutashika tukiandika haya. Sasa andika notes. The net realizable value is the market value. Net realizable value is the market value less the cost of sales. Net realizable value is the market value less the cost of sales. And I say discussion is very important because my notes are very short. Kuna haja kuandika sana. Sisi kwa example mnapatunga 3 hours ya kufanya exam. You don't write too much. Bora umeelewa. And my discussion is 60% discussion, 40% notes. While the cost of the inventory shall be, number one. The cost of the inventory shall be number one. The cost of the inventory shall be number one. The cost of purchase. Looking for when it came in exam. Number one, the cost of purchase. Cost of purchase. You say something. This is the initial cost. This is the initial amount incurred. Let's just say this is the initial amount incurred. This is the initial amount incurred to purchase the inventory. This is the initial amount incurred to purchase the inventory. Number two, that was number one. Number two, cost of conversion. This is the cost incurred. This is the cost incurred to transform the stock from raw material to finished goods. To transform the stock from raw material to finished goods. And lastly, number three, the cost of bringing the asset to its current location and position. The cost of bringing the asset to its current location and position. So it is the lower of the two. The asset to its current location and position. I'm looking at a sitting here, last sitting, December 2025. Question 5, number 1. Question 5, additional information number 1. Question 5, additional information number 1. I can read it. Just the additional information. So that now you see where you can use this. Physical stock counted at indicated that the inventory as at 31st August 2025, it is the last page. The last paper. So it is the question number 5. Sumeyona. Question number 5, additional information. Okay?
Yes.
Physical stock counted indicated that inventory as at 31st August 2025 was valued at 54,226,000. It is estimated that these goods can be sold at how much? 57. See the market value. After incurring a cost of how much? 4.5. After incurring a cost of 4.5. So we have, it means then we are going to compare between 57. What is the net realizable value? It is 57 for 50 minus 4.5. How much is that? So the net realizable value is 57,450. You are supposed to minus 4,500, which tells me that is 52,950. So this is the net realizable value. What about the cost? The cost is 54,226. So you can see that in such a value is lower. So in such a case, you are going to consider that 52,950 as what? The 52,950 as the cost of the inventory. So this is the physical, this came in the last sitting. This is how physically we use this information that we are giving out. So I can proceed and say, how did we start? Did we say at the end of the year the goods are physically counted? Have we used it in our notes? So we say, you can say a favorable cost measurement method is used. A favorable cost measurement method is used after physically counting the inventory. A favorable cost method is used after physically counting the inventory. These methods are the only two methods according to IAS or rather IFRS. These methods are the first one, first in, first out. First in, first out, and the other one, weighted average method. Now, from here, the examiner will not go more than this. To ask you now, giving an example, what you do, I have not seen it. It has never been. But basically, you consider the goods that came out as the first goods that you sold. And again, or if you don't know it, use an average. I bought this number of goods, and this was the average pricing. So you just take an average of the prices you used and assume that is your cost per unit. I don't know if it makes sense. Does it make sense? How many will be Peter? Peter will be it. For that one, I don't need to take too much time. If you are kuhusu people, a weighted average method, don't have to take too much time. Sasa tumeangalia hiyo. So not you can comfortably ikikuja inventory 5 marks measurement of inventory, you can comfortably write those notes as they are. Alafu patana hizo marks zako 5 uende nyumbani. Nyumbani ni section 2. Okay, wenye wako hapo. Let's now look at I want us now to start defining sales. So we can now talk about sales, and you can say that I need to introduce it first. I need to introduce it. Just a minute. Just introduce it. I need to introduce what sales is. Tumesema hii ni store yako. Hii ni store yako. Kitiko ndani ya store tunaitaje? Inventory. Na huyu ni jamaa fulani anaitwa supplier. Jamaa fulani anaitwa hapa supplier. Na huyu ni jamaa fulani anaitwa nini? Customer. So ni customer. Customers ni mtu unauzia vitu. Goods zikitoka kwa supplier ziende kwa store. This is your central stores. When goods come from your supplier to your store, we give it a name. The name we give it is what? Purchases. So today, if you see the name purchases, it is not the same purchases that you used to know. The name purchases today mean that goods that come from the supplier to my store and I have the intentions of selling them. That is what purchases is. When they reach here, I call them now inventory. When this inventory comes from my store to the customer, I call it sales. Tunapatana vizuri. Sales, when the customer, maybe you can remember what you said about credit note. A customer anaweza pata hizi goods zimeharibika, I decide kuturudishia. You know, there's this very nice analogy. Kiwa wadogo, our mothers really used to make us feel, siko tunasikianga, ushituma maziwa. Kitambo maziwa haiko inapikwa hii ya duka. I don't know if kitambo, how kitambo is kitambo. Let's see if you had it. Ama wale wa villages, we used to be, tulikuwa tunatumwa, tunanunua maziwa ile ya kupima. Inapimwa, unapima hadi mahali unapima. So unatumwa, unaenda unanunua, chai inaanza kuiva. Alafu ianze kuchemka, ipatikane imeharibika. What used to happen? Mama hapa anakupatia hiyo sufuria na kuambia urudishie huyo mtu, mwambie ameniuzia maziwa imefanya nini? Imeharibika. What next used to happen? Unabeba sufuria unamrudishia. Na anakufuata nyuma, unajua sasa kwa nini yeye mwenyewe akubeba hii maziwa peke yake. Unaibika kwa barabara saa mbili na sufuria ukienda. Ukisharudisha hiyo maziwa, anasema either unipatie maziwa mengine ama unirudishie pesa yako. Si ni kwamba hivi something like that. Or you guys don't have such experiences. Hamjarudisha na sufuria kwa duka. Nyinyi mmeishi maisha mzuri. Ziko unarudishwa. So if this person decides the goods, it will change its name. The name is now called return inwards. Mona, it has changed its name. Alafu pia sisi, if we're not satisfied with these goods, we will change it. The name is called return outwards. Sometimes this return outwards is also called purchases returns. These return inwards sometimes is called sales returns. See rahisi sana? Yes. Very easy. Very easy. And which document is this? These two documents, we use a document called credit note. You return them using credit note. Either you receive a credit note or you give out a credit note. So let's start with let me see your books. Umeandika topic sales. Kwa hivyo umeandika sales. These are goods sold. These are goods sold whose original intention is to sell. These are goods sold whose original intention is to sell. Remember, the original intention has to be there. Whose original intention is to sell. I know you want to draw this table, or you don't want to draw it. I write a lot of things. Whose original intention is to sell. Sales may either be cash. Sales may either be cash or on credit. Sales may either be cash or on credit. So today, if you hear the term sales, and it is this sales, not this sales. COE. Tunaongea kuhusu this sales. Sawa. Yes, sales I'm talking about sales. Sales may either be cash or on credit. Sales may either be cash or on credit. One, if cash sells, what is coming in when you sell goods by cash? What is coming in? Cash is coming in, okay? So if cash sells, debit, cash, credit what? What is going out? The stock. But when stock go out, we call it what? Sales. So when you're doing debit credit, for those who are not there, we look at what is coming in versus what is going out. It is easy to look at it from that direction. So sales, cash is coming in, but we are losing our stock. And when we lose our stock in the name of, with an intention whose original intention is to sell, we call it sales. Number two, if credit sales, debit, if credit sales, debit, debtors, what is coming in? See the debtors. You are getting an asset called debtors. Means this person unaweza mpigia simu anytime akupatie pesa yako. You are gaining someone called debtors, and then you are losing someone something called inventory, whose original intention was to sell. Okay? So you look at the second one. Which is the second one? Purchases. 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 Now we are here. Purchases. These are goods bought. Okay, you are still drawing. Nitawachia mchoro usijali, sitafuta anything about. I'll let you draw that diagram so that I want to finalize it in the next 20 minutes. The class should be off. So now I need you to draw. Purchases. These are goods bought. These are goods bought with an intention to sell. With an intention to sell. S-E-L-L. With an intention to sell. With an intention to sell. With an intention to sell. It may either be purchases by cash or on credit. It may either be purchases by cash or on credit. Either be purchases by cash or on credit. If cash purchases, so what is coming in if it is cash? What is coming in? The goods, eh? So the goods are coming in, and when they come in the name of purchases, we call them, in the name of selling, we call them purchases. Then we are going to lose our money, cash. We are going to lose our money, cash. We are going to lose our money, and we call it cash. We move to the next one. The next one is what? Sales returns, right? Sales returns. So these are, you can see it is the same goods but have different forms. It is taking different forms depending on where is it going or where is it coming from. So it is taking different forms. When it comes from customer to us, it is called return inwards. Us to suppliers, return outwards. So we can say sales returns or rather return outwards, which are return inwards, whichever you deem fit. Return inwards. Return inwards. These are goods returned by credit customers. It's very important there. These are goods returned by credit customers due to reasons such as, I think we highlighted the reasons when we are doing credit note. Due to reasons such as A, spoiled goods, A, spoiled goods, A, spoiled goods, B, A, spoiled goods, B, wrong goods, wrong goods, wrong goods, or C, excess goods, or C, excess goods, C, excess goods. So we had already used it. Now cash is not involved. We are simply reducing the amount that we should receive in future. So what are we gaining? We are getting the inventory back. Senior, what is coming into the company? The company, the business is receiving goods back. But these goods now it is receiving, it is calling them return inwards. And the goods that it is, and what are we losing? We are losing the money that we should receive in future. This money that we are supposed to receive in future will now not receive it. So we are losing that aspect of money that we receive in future, and that is why we credit debtors. For first timers, there should be credit debit meaning. Just life goes on. After the third class, you'll be okay. First class, second class, third class. Mambo iko chonjo. Mambo iko chonjo kabisa. Chonjo kabisa. We move to the last one. The last one. I'm not rubbing anything on the board. The last one is called return outwards. Return outwards. Return outwards. Return outwards. Return outwards. These are goods taken back. These are goods taken back to credit suppliers. These are goods taken back to credit suppliers. What's the other name for credit suppliers? Creditors. These are goods taken back to credit suppliers. The reasons are the same above. So we don't need to repeat everything. The reasons is wrong goods, leading excess goods. The reason will come at you. I don't need to repeat myself. So because goods are moving outside, so we are going to credit return outwards, and then we are reducing our liability, the amount that we are supposed to pay in future, and then you say creditors, you debit creditors. We are going to look at questions. This debit credit, don't suffer so much in your heart. When you'll be doing accounting equation, which we just touched on kidogo, when you're doing a practical, I think in the next class, we should be able not to do a question on these ones. Any question, anything more than that, now need discussion. Questions is allowed and no question is wrong. Nimemaliza kufunza. Niwapatie vitu mbili, ni lazima zikuje kwa exam. Either in whatever form, lakini imeko. Any questions that I can handle? Sina nikuuliza tu watu kuanzia huko nyuma. Mzai? Question? Uko chonjo? Melda? Question?
I can ask.
Yes.
You get goods when they come in or not?
When goods come in. Oh, when goods come in. Tuliandika na credit kweli? Debit purchases, tuliandika by credit ama tuliandika by cash peke yake? Purchases. Cash peke yake. Peke yake. So hapo B, andika B, atafuta mahali hapo kwa andika if cash purchase, if credit purchase, you debit purchases, you credit creditors. If credit purchase, debit purchases, credit creditors. Debit purchases, credit creditors. If credit purchase, debit purchases, credit creditors. Does it answer your question? See, goods zinakuja, so automatically I'm going to debit the goods, okay? But when goods come in with an intention of selling, we call it purchases. So that's why I'm debiting purchases. And what am I losing? I'm losing my cash. I know the issue of losing it to creditors. I don't want to discuss it. It will be in the introductory of the next class to say, man, why are we crediting creditors and why are we debiting debtors? And you're going to look again at the definition. So I want you to go and look at the definition of a liability. Try and ask yourself, what is a creditor liability? Look at the definition of an asset. What is a debtor and asset? Then when we come next, we now understand more. To explain for the last 5 hours. I don't like explaining before you read. To haita make sense na utasahau haraka. So soma, tutarudi tena kuangalia huyu mtu. Sana sana huko creditor. This is my personal interest. Hata usipoelewa saa hizi niwaambia, we are going to have a subtopic on him and talk about him under control accounts. Sawa. Any other question? Yoko, amuko sawa? Okay. So the class is over.